Many people would assume that a bank needs to get money from a saver before it can make a loan to a borrower. After all, isn't that what banks do? Taking money from people who want to save it and lending it to businesses and people who need to borrow. Well, not exactly. Here's a fact that not many people know. A bank doesn't actually need to have any real money before it can make a loan to someone. When you take out a mortgage from the bank doesn't take that money from somebody's grandma's life savings. No, instead, they simply open up a computer and type some numbers into your account. You get a huge wad of money in your account, and you also get a huge wad of debt that you'll be repaying over the next 25 years. But the money that you borrowed was created out of nothing and just typed into your account. Well, we know that's hard to believe, but you don't need to take our word for it.
One of the most memorable quotes about money and banking is usually attributed to Henry Ford. He said, "It's well enough that people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning." Well, let's hope we don't have a revolution, Mr. Speaker, because I feel sure we're all Conservatives on this side. How's it done? Well, the process is so simple, the mind is repelled. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. Many times I've been told that this is ridiculous, even by one employee who'd previously worked for the Federal Deposit Insurance Corporation of the United States. The explanation is actually taken from the Bank of England article, Money Creation in the Modern Economy. It seems to me rather hard to dismiss.
Your article focuses on broad money. What determines how much of that there is?
Well, broad money, which in many ways is a better measure of the amount of money circulating in the economy, includes all the bank deposits of households and companies. And one of the key points of the article is that banks create additional broad money whenever they make a loan. Now, while this is nothing new, it is sometimes overlooked as the main way in which money is created, and it runs contrary to the view sometimes put forward that banks can only lend out deposits that they already have. In fact, loans create deposits, not the other way around.
Banks do not, their primary economic function is not as an intermediary just recycling our savings, as this kind of diagram shows. Banks are creators of credit. They create brand new purchasing power, okay? So there's a quote there from the Deputy Governor of the Bank of England, subject only but crucially to confidence in their soundness. Banks extend credit by simply increasing the borrowing customer's current account, which can be paid away to wherever the borrower wants by the bank writing a cheque on itself, which is essentially the creation of this liability. Now, I hope that's clear to everyone, because Joseph Schumpeter, who is one of the greatest economists, I think, that ever existed, and he'd be my sort of number one choice if you want to read one of the classics, this book, History of Economic Analysis, 1954, observed back in 1954 that economists found it very difficult to get their heads around this simple concept that when banks create loans, they also create deposits. Funnily enough, 57 years later, we still seem to have the same problem.
They talk about how you can only model a complex system like the economy of making what they call simplifying assumptions. But what they call simplifying assumptions, any sane person would call fantasies. Okay? So their fantasies include that banks' debt and money don't matter, one of their fantasies. And how do they get that fantasy? They say that, oh, well, banks just intermediate. Banks arrange a loan from a saver to a borrower, and they charge a fee for arranging it. And they don't play any active role in creating money. Now, the Bank of England, bless their cotton socks, have come out with a fabulous paper saying that's nonsense. Okay? Banks are originators, they are not intermediators. And when they originate, they simply write an asset on one side, which is the loan that you owe to them, and a deposit on the other side, which is a liability for them at the same time. And they create money in that sense. So that is an essential part of the dynamics of capitalism. Now, when you look at it, it shows that the creation of debt by banks is a huge part of both the creation of money and creation of demand and income. And equally, when debt's paid off, it's a destruction of money and a destruction of demand and income. So it's a vital issue, and they ignore it by the simplifying assumption that banks are intermediaries rather than originators. And that's in some ways, it's the simplest, stupid, wrong assumption they make to make their lives easier as mathematical modelers. But it's the core one, because once you've done that, you ignore so much of the real world. you might as well be writing fantasy novels for Disney.
Now, what is the link between the monetary system or monetary factors and money growth and economic growth? Well, actually, if you think about it, what actually is growth? The way we define growth, GDP commonly is the way we look at it. Really, when we say we've got GDP growth this year of X%, this means that this year we've got more transactions in the economy than last year. Now, for transactions to take place, money has to change hands. Well, in practice, the majority of money is through bank transfers, so maybe it's not even changing hands, it's just changing bank accounts. But the money is flowing in the economy, and therefore, to have growth, we must have more money being used for transactions. Now, the type of economic system we have and financial system we have dictates that certain things about this. How is it possible to have more money changing hands for transactions? Where does it come from? Somebody has to create this money and allocate it. Now, most people, when we talk about the money supply and how money is created, think, well, of course, this comes from the government or the central bank. And most people are quite surprised to hear that in most countries, the tangible money, notes and coins that comes from the central bank is only 2 or 3% of the money supply. Actually, the notes and coins are more or less a drop in the ocean of economic transactions that we have in the economy. Where does the majority come from? Who creates 97% of the money supply in most countries? Well, nowadays we have debates about whether we should privatize hospitals, whether we should privatize prisons, whether we should privatize almost everything. And at least there's, well, a certain amount of debate about it and a certain amount of quite sensible resistance to these ideas. But few people realize that the biggest privatization has happened a long time ago of something that most people think should never have been privatized. And that is the creation and allocation of the money supply. This is actually done by private, profit-oriented enterprises. Who are they? The banks. They create the money supply. 98% of the money supply. I think what's extraordinary is that we've outsourced the money creation and allocation to the private sector. And that if we want to have more growth, we need the banks to create more credit, and therefore somebody needs to borrow and go into debt. So more growth requires more debt. I think that's really the extraordinary thing, that we have such a strange and inefficient system of money supply.
So almost all the money we use today is made in this way, out of nothing, by banks when they make loans. And the only way that we as the public can get our hands on this money is to go into debt to the banks. In other words, almost every pound that we need in the economy to run shops, businesses, factories, schools and hospitals must first be borrowed by us from a high street bank. And if one person has £1 million, the rest of us must be £1 million in debt. If we try not to go into debt, then the banks would be unable to create money and the economy would grind to a halt. This is effectively a whole-scale privatization of the power to create money.